This session is organized by the Fractional Finance Forum. So my name's Elliot. I run that Fractional Finance Forum. It's a community of any finance professional who works in a fractional capacity. So we have in our community a bunch of fractional CFOs like myself. We have fractional accountants. We have bookkeepers. We have financial modelers. We have fundraising advisors. We've got the lovely Andrea, who's a transfer pricing expert. It's a really great community. I think a number of the names who have joined, I do recognize as being members of that community already. So thank you very much for being part of that. And if you are joining us and you're not a member of the Fractional Finance Forum, it's absolutely free to sign up. And it's just at the moment, it's a really good active WhatsApp group, and we do a number of sessions throughout the year. So webinars on subjects that we think are interesting, like transfer pricing. We've also done ones on how to use AI and set up your own AI agent. We've done sessions on valuations and financial modeling. And I'm always looking for suggestions. So anybody else who says, you know what, we should really do a session on this or that, please just let me know. I have to leave at 10 o'clock, unfortunately, for something I couldn't move. If we're still going, like I said, there's about 15 minutes assigned for questions at the end. I'm just going to promote Andrea to host, which should leave the session running. And then Andrea can then end the session at the appropriate time. This is all being recorded, so we'll be sending on the recording afterwards to capture, as long as you signed up and to the session, which everybody here has. You'll be receiving the recording as well, but we're not sending the recording of the Q&A session. That's just for if you join live on our webinar today. So that's enough from me. I shall hand over to Andrea. Thank you very much.
Thanks, Elliot, and thank you very much for having me. I'm very passionate about transfer pricing, so any opportunity to talk about it, I'm happy to do. And as Elliot said, we'll do a bit of Q&A at the end. So if you've got any specific scenarios that you kind of want to talk through, or just get a bit of a lay of the land, we'll do that at the end. And that's another reason why we're not going to record that, so that you can actually sort of, ask those questions. But as I go through, I'm going to assume that you know nothing about transfer pricing, and we're going to kind of build up from there. But if you do have any questions as we go, please just ask them. If I skip or go a bit too quickly, just let me know. And I'm going to share my screen. Got some lovely big slides, so hopefully you should be able to see those now.
They're just loading on my side. Yep, I can see those. So everyone should be able to see those.
Okay, so hopefully you should see the agenda. So what I'm going to do first is I'm going to talk a little bit about what transfer pricing is, and we always push it down to TP, and the arm's length principle, so the ALP. So what are those two basic concepts? And then a little bit about how we apply the rules. What I would like to talk about is some specific examples which I think might resonate with some of you in terms of how your entities are operating, either service transactions, supply chain, and then a little bit on intellectual property. IP could be anything from specific research and development to anything AI to brand, things like that. So it's quite a broad term that we use, but it's also probably the most critical, and particularly in today's environment where IP is what's differentiating different organizations. The rules and the way you can structure and set up your IP becomes even more complex and more important to think about as you're looking at your transfer pricing. I then want to talk a little bit about transfer pricing documentation as a whole. I'm not going to go into the specifics. And then finally, like what to do, when do you need help, what do you need to think about, and just do a few very basic concepts of how to sort of manage that, and when to ask for help and when do you not need help. And then obviously we'll go into the Q&A.
Right.
So as I said, sorry, Elliot.
Yeah, that's great. I think it seems like a really good session. And for me, this is a subject I know little about. So I'm really looking forward to learning it.
Well, let's kick off with what is transfer pricing. So everybody hears about it, and you would have read loads of stuff in the paper about it. Like my parents years ago, I've been working in transfer pricing for about 25 years. I've worked all over the world. I've started in New Zealand with KPMG, then I moved to the US. I've worked in the UK, I've worked in Singapore, I've worked in Australia, I've worked in India, I've worked in telecommunications, mining. I was also with GSK for 5 years. So I've done a lot of transfer pricing, but it was a long time before my parents really understood what it was that I actually did. And it wasn't until you read about things like Google and Starbucks shifting profits to Ireland, which you all would have read about in the paper. And my mother said, "Oh, that's what you do." in a nutshell, kind of ish. That's not particularly what I do. But transfer pricing is about setting the prices between two entities. It applies to all transactions between associated entities. Now, we use lots of terminology, associated entities, intercompany, those sorts of things. For the basic rules, it's any transaction between two entities, regardless of whether they're in the same jurisdiction or not. So in the UK at the moment, there are UK to UK transfer pricing rules, and I'll explain why that is in a second. But it's looking at the price of whatever is being provided from one entity to another. Cross-border transactions can be either goods, so in a supply chain situation, or where you're buying goods from a related party. It could be services, so the provision of active services. It could be R&D services, financial services. You could just have a person located in another territory because that's where they choose to live, providing services into the entity. Financing, if you're providing any loans, and then also intangibles, which, as I said, is that IP category, which is very broad and is getting broader as we go. So the transfer price is the price that's paid for whatever goods or services is being provided from one entity to another. The arm's length price is the point of transfer pricing. So trying to set that price at a rate that puts the appropriate amount of profit in each of the two entities. Now, why do we do that? If you think about the point of that is we're trying to identify what two independent entities would price a good at. So we're going to getting complex here. But if the two entities were not related, how would they price that good? So you've all sat through commercial negotiations where you finally agree a price with a third party. That doesn't happen when you're related. You just say you need something and the entity is going to provide it to you, and then transfer pricing comes back and says, okay, well, what should that price be? And there are a number of ways in which we do that. Transfer pricing in itself is not a tax. What we're trying to do is identify the profit element that should sit in each of those entities. Elliot, I'm going to look to you and I'm going to say, is that clear?
That makes, I think, a lot of sense. I'm interested in that part you said about UK to UK transfer pricing, and also just how much of this is part of what businesses need to do day to day. You know, they just do have to send stuff between, especially if you think manufacturing is the easy one to think about, right?
Yeah.
I have to send stuff between my entities across jurisdictions. How do I do that? And then also from a services perspective, how much of it is just trying to move profit around and how much of it is just genuinely we need to have people in certain locations. That's all making a lot of sense. Yeah.
And there's different parts of that, and it's a good point because again, transfer pricing is really very much focused on legal entity, but we will come to a permanent establishment in a second. I do want to just talk through that concept. But it's usually from an entity to another entity. And, you know, particularly when you acquire groups and you integrate other organizations, you get all these different entities. But at the end of the day, tax is based on a legal entity perspective. And so the profit that sits in a specific entity is what is going to be taxed. And it's the transfer price that is going to help pull the profit into the right place, into the right entity, so that the tax is then paid. And that's kind of the point, and that's why it does become quite complex, because in most CFOs' world, you're not so fussed about the actual legal entity. You're just interested in, okay, what do we need to do from a commercial perspective to sell the goods or manage the P&L, etc. It's only that kind of statutory exercise that you've got to do to actually split all the costs and all the profits into the right place. Tax authorities don't really appreciate that. They're starting to, but at the end of the day, the tax is based on an entity level. And that's why transfer pricing becomes quite important from both a compliance perspective, but also just a profit perspective.
Yeah, and I think it can. So my only sort of exposure to transfer pricing is UK to UK. I used to do a lot of work with private equity, large scale asset financing. And as you imagine, we had quite a few entities. We had several different banking groups. We, were borrowing couple of $100 million at a time. So we were using transfer pricing as a way of moving cash around the group within the rules of the bank. So my concern was, what would the bank let me do? And what is reasonable and third party and arm's length, but I wasn't having to consider the tax of it because it was UK. Yeah,
and moving cash around is really important, and actually transfer pricing can help with that. I often get, when I was with KPMG, I've been a partner there for 5 years, very small companies in the early kind of startup phase, trying to move cash around. Actually, setting your transfer pricing can actually sort of facilitate that moving of cash into the right place. Because often what you end up with, and when we look at some of the examples, you end up with cash at a front-end entity, but you actually end up with a cost all in another entity. And so the transfer pricing should help you move the cash through the organization to get it to the entity that's actually incurring costs in the first place. The UK rules at the moment, and most countries have local transfer pricing rules. So a UK entity to a UK entity needs to set the pricing at an arm's length rate. Now, the UK are looking at removing that rule, but there are a number of exceptions. And the exceptions are whether they're getting a tax benefit. So if you have a patent box entity or an entity that's registering for a patent box, you're obviously going to get a lower tax rate on that. So people would ideally like to move as much profit into that entity as possible. Therefore, transfer pricing needs to look at the price of what's going into that patent box entity to ensure that the right amount of profit is sitting in the entity that's going to be taxed at a lower rate. You see a lot of it in financial services as well, where you've got ring fencing. So there are different tax rules for some of those entities. So therefore, the transfer price has to be looked at as well. So the UK are just going through those rules at the moment, and we expect probably HMRC to come back maybe later in the year, although this is the 3rd year they've been looking at it and they still haven't removed that UK to UK transfer pricing requirement. But if you think about whether one of the entities is going to get a tax benefit by shifting more profit into it, then you can assume that HMRC would have a problem and want to see that a transfer pricing analysis has been done on the movement of whatever that happens to be. So we're looking at the taxable outcome to help then drive whether transfer pricing is going to be a factor. If the two entities are just two UK entities, then the risk is very low. You should probably think about it, but actually if there's no tax benefit and they're all in a consolidated group, then it's probably not going to be something on HMRC's radar.
Great. Thank you, Andrea. Okay.
Okay, so let's go. Can't move my slides. I've been so long on this one. Okay, so how do we apply transfer pricing? As I said, I'm not a tax person. I'm more of a business person, but I've been working in transfer pricing for 25 years. I've picked up a lot of tax. So what you tend to find is transfer pricing people, corporate tax people, indirect tax people, R&D specialists, and we've all got our different ways in which we look at things. So transfer pricing is really, as you can see on the left-hand side, it's about understanding the business. So if I said I was much more commercial than I am tax-driven, that's because the first thing I start to do is look at, okay, how does your business operate? Where are you based? What are you doing? What's important? Who are the key decision makers? How influential is the CEO? How important is the board at making core decisions, etc.? So 90% of the work for transfer pricing is really around understanding what are the functions of the entity and the people, what are the assets of the company, and then what are the risks and how are those managed. We then spend a bit of time looking at the financials. It's quite critical to know kind of what the current transactions are. Are you loss making? Are you profit making? What's that going to look like over the next 5-10 years? Where are those costs being incurred? How is money being moved around the group? And where are you putting profits or losses, or just generally where are costs being collated? The other piece we like to look at as well is a little bit about the industry. Although for transfer pricing, the concepts are pretty broad. We have a lovely set of, I've probably got it here, international guidelines. So we have a little book. All countries.
Oh, that looks exciting.
Yeah, I know. But when you consider that next to tax legislation, actually we've got off pretty well. So all countries refer back to the OECD guidelines. So that is the Bible. And then there'll be local rules for implementation. And so then you have to understand what the local rules are as well. So the UK has been developing their rules, unfortunately for smaller companies, not in a positive way, because they're concerned that they're missing out on part of the tax net. So they're widening the rules to apply to smaller companies as well, to make sure that some sort of transfer pricing analysis has been done. However, the one thing I would say about HMRC is they're pretty comfortable that you do the amount of work that is required for the size and the risk of the entity that you've got. So it means you don't have to always do the full-on transfer pricing study. The other thing about transfer pricing is, and when you think about some of the big cases that you might have seen in the paper around transfer pricing, it has to align to how the business is operating. So in the past, lots of people set up an island where there was a very low tax rate and shifted loads of profits in there, but had no people. No longer is that true for transfer pricing. In fact, I would have argued that that was always a bit on the edge. No longer can you fly your board to Jersey three times a year and agree everything and then put all your profit in Jersey and pay a really low tax rate. So nowadays we're much more focused on actually what does the business do, and then how does the transfer pricing support how the business wants to operate. And then on the right side, just the steps that we would go through. So we'd do a function asset risk analysis, we'd collect a lot of data, we'd review the financials, and then I would say there's two kind of steps. First is setting the strategy for transfer pricing. So what do you want the transfer pricing to do to support the business? And then the next part of that would be formal documentation. And I will come back to the documentation at a bit of a later date.
Yeah. Can I just ask, as we're going, we've got one question in, which I'll ask in a second, and also if anybody on the call has recently had to go through transfer pricing or is currently going through transfer pricing and is brave enough to sort of put their hands up and ask the question, if I unmute you, has anybody gone through those steps on the right? So whenever I did transfer pricing for this UK to UK group, we did, it wasn't as formal as that. I always work on the basis of, would I sit in a room with a tax agent and with a straight face explain what we did, or would I be embarrassed to try and get away with it? And I always erred on the side of I would just want to do it straight faced, knowing I was above board. We put in proper contracts that were big service contracts that we would have signed up to if we were buying this commercially, and on all those sorts of things. So if anybody is going through it and wants to sort of comment on whether or not this process is similar to what they think they were going to have to go through, please do. And then the question that came in was from Paul, is are we going to mention anything around thin capitalization rules as well?
Well, I could spend an entire hour just on thin cap. Thin cap in itself is not a transfer pricing rule. However, there's two stages to it. So thin cap, for those of you who may not know, is when you look at an entity and whether it's thinly capitalized or not. So what we've seen in the past is we've seen, and we see it in really, really large groups, not so much anymore because the thin cap rules are pretty much everywhere now, but we see instead of putting capital into a local entity, they put lots of debt in, and then they can pull that out as interest transactions. So you get a deduction in the entity that's borrowing the money, and you get some profit in the top entity. And entities in the past have set themselves up in all sorts of places, like Malta was one that I worked on, where all the loans come out of Malta into all the different entities, and you get a lower tax rate on financing in Malta. And Ireland's a little bit the same. They've got a different tax rate for financing transactions. So I'm not specifically going to cover thin cap, but you do need to bear that in mind when you're thinking about providing loans into certain entities and what the ratio of your capitalization to loans are. And then you also have to go a step further on the loans and look at what an interest rate might be, an arm's length interest rate. And what I would say on that particular thing is, and how it gets quite complex between those two pieces, is that if your thin cap's not correct, then you get an amount disallowed out of your interest. If your transfer pricing is not correct, you'll get another cut off for your disallowance on the interest. So it's worth spending a bit of time just kind of working through, okay, what's the thin cap ratio, what's the arm's length interest, and then just looking at that in the whole and saying, is this the right way to fund the specific entity? But it's something that we'd need an international tax specialist to come in and support on as well, to bring the two concepts together. And look, that's the fundamental issue with tax, right? We're all experts in our little pieces. If you think we're bad, the US are even worse. They have specialists on specific sections. But it's hard to find a generalist who can cover all of those rules because the two rules have to work together. And there's always been a bit of an argument about which one you look at first, the transfer pricing or the thin capitalization. I'd say do the thin cap first and then the TP.
Okay, great.
But it's
Thank
a
you.
really good question, and yeah, we would have to put together another whole hour on ThinCap, unfortunately.
Okay, well, good. Paul, thank you for the first question coming in. That's fantastic. Thank you. And Andrea, good. Well,
So
okay.
I want to move to some basic scenarios now, and these are really basic ones. I've just been in Vienna lecturing. There's a transfer pricing course that they do, and I had some actual live examples, and the class were like, "Couldn't you just give us some simple ones?" And I sort of said, "Well, these are ones that actually exist." So what I've got on the screen are very simple examples. So what we've got is a UK headquarter. I've started with the UK because obviously we're a UK group. So in all of these examples, the UK is a headquarter. There's some contract R&D team based in Poland, and the head of manufacturing decided during COVID that he liked France better than the UK, and he moved to France and runs everything from France now. The UK is the only one in this example who can sell direct to customers. And so the way we would look at this from a transfer pricing perspective is we would say that Poland and France are service providers into the UK who is a service recipient. There's no commercial risk in Poland, and there's no manufacturing risk in France because the UK kind of hold on to all of that risk as they're the ones who charge into the customers. So from a Polish and a French perspective, now this is a very basic example. There will always be exceptions to this, and we'll come on to why that can be quite complex later. But Poland would expect to have a profit. So the Polish tax authorities would look at this and they would say, well, hang on a minute. All we're doing is contract R&D. All of the senior staff are in the UK. We have really no control. You tell us what to research and develop. So we would expect to have a markup on that. Now, I've used cost plus. You would have to analyze, and I will talk about there are other methods that you can look at. But ideally, in a service transaction like this, you would take the fully loaded costs of the Polish contract R&D team and any of their facilities or any support costs that they require, put a markup on that and pass that through to the UK. In France, you've got one guy, he's sitting there on his own. He's got his costs incurred in France. And so again, the French tax authorities would say, well, hang on a minute, you've got a person here based in France. Okay, maybe they're not strategic because the manufacturing activity is not what we would consider strategic, but we would expect to see a profit in France. So again, you would bundle up all of his costs. Even if you are paying him from the UK, you would still look to that and you would put a markup in France. If all the costs were being incurred in the UK, and we see this sometimes where the UK have hired maybe a payment facilitation in France to actually pay in France, again, you would still look at all of those costs and you would say, right, that person cost 100K, so we're going to say 100K plus a markup of anywhere between 5 and 10%. So the profit element that you'll see in France will be that 5 or 10%, and that's what you would pay tax on.
And have you just picked that 5 to 10% as like a random example, or is that's always considered reasonable?
Yeah, well, yeah, it's a good question, and it really depends on the person and the function. So, this has been an argument in transfer pricing for years and years and years, but the OECD brought out a couple of years ago a safe harbor of 5% for low value adding services. This is an appalling name as far as I'm concerned, because trying to tell somebody that they would be considered low value adding by the OECD is difficult. But to be low value adding, you have to meet a number of tests, one of which is you need to not be core. So most finance staff, most HR staff, most legal, etc., that all fall into the low value adding, and you can just add a 5% markup on that. Yeah, I know. It's a really difficult, even though I would be low value adding service of 5%. So if you're not core and you're not a core part of the business, then you can try to apply for that 5%, and most countries should respect that. If manufacturing is one of the core parts of your organization, or maybe you're a financing entity and so finance is a critical part, then you're no longer core and you'd need to look at what a markup would be on that. And then we would have to run a services test. We'd need to do a comparability analysis and look for a bunch of comparables doing similar activities to determine what the appropriate markup would be. And actually, when you do transfer pricing with any of the big four or any of the accountancy firms, that's where the majority of the cost comes in, is actually looking at what those markups would be. And what I would say on that piece is that depending on your size will depend on the risk that you have and whether you really need to undertake that, because a normal benchmarking analysis is around 7 to 8K, which is a lot of money to give you one number that you were then going to use to add as a markup. So you really want to see if you can apply that 5% first, or just think about what's reasonable based on the services. So in this particular example, I'm going to assume that it's a life sciences company, and so manufacturing is important, but it's not the critical part, because actually the critical part is the IP, and so therefore a cost plus of 5% or something along those lines will be appropriate. Now, 90% of arguments with tax authority is on the cost and the plus. So have you calculated all the costs correctly, and have you added all the pluses correct? And is it the appropriate plus? And if you're arguing about what the plus is, then you know that actually you've won the argument about the service, the characterization of the service. It's not a core function. And then they're really just trying to top up their tax revenue. So if you're spending a lot of time arguing about pluses, that doesn't mean you should just raise the pluses. They're never going to be happy with the plus. They're always going to try and push you. So at that point, you really do need to get some sort of comparability analysis that you can prove that plus is appropriate. The only other thing I wanted to add onto this slide, if there's no questions, is what if there's no entity in France? So because it's one guy, he moved, you don't want to set up a legal entity. You don't have to. But what you've created here is what we would call a permanent establishment. So the UK has created a permanent establishment of itself in France, for which this one person is operating. So in that case, it's almost like operating as a branch. So what you would file a return in France, again, based on that cost plus. In fact, you might not even have any cost, because all the cost has been incurred in the UK, and you just have a profit margin that you would pay tax on. So you need to look at the permanent establishment rules in each of the countries, but ideally you would file a tax return based on a branch of the UK entity. Most countries are now looking at permanent establishment as being a big issue, because obviously following COVID, everyone's working from anywhere, and that's become really complex and difficult for them to manage. Some countries are very aggressive. Italy is incredibly aggressive on permanent establishment. If you have people in Italy who are providing a service, you really want to go and get some advice on how to support that and make sure you're doing the right thing, because the criminal liability in Italy is quite strong. I had a director who was based in Belgium, but criminal charges were laid against him for negligence, for not doing the right thing. So Italy are very strong on this, particularly where they feel there's some money on the table that they need to go after. So permanent establishment, when you have a person in another territory, you need to really look at that person. If that head of manufacturing was the head of R&D, now you've got a bigger problem, because the cost plus may not be appropriate. You may need to think about whether there's a proportion of profit. If there is profit, that needs to come back into France. So again, the role of that person is really important as well. And we'll talk a little bit more about that in the IP piece. Although I do want to kind of get through these. So I will go through these ones quite quickly. Supply chain, again, very simple example. Obviously, we said the head of manufacturing is in France, so he's set up a little packaging organization. There's some packaging there. The transfer pricing rules apply exactly the same to goods transactions as they do to services transactions. So what we do see in goods transactions, though, is we see a difference sometimes between the financial and the physical. So in this case, the financial goes directly from Denmark, the third party, to the UK, so all the costs are incurred in the UK. But the physical, we see a difference where the Denmark are giving it to the French team. The French team are doing finalised packaging and then selling it all to the UK. This creates a number of VAT issues, and you really need to consider what the VAT impact will be in the local countries as well, because you've got a difference of price going through France, and you need to register something in France for that delivery from Denmark. Obviously, Brexit created even more complexity, and so the registration for VATs becomes even more onerous for companies. Again, France, I would say it's an ancillary service, it's just packaging. So again, you would look at, okay, what's their fully loaded cost of doing that work? And can we just cost plus that through to the UK? You don't need to include in that the cost of Denmark. Even if Denmark was a related party, again, you need to look at what should be in that cost plus. You're trying to provide a return on what the French team are doing. So that original manufacturing in Denmark, they're not adding much value to that. They're really just separating that into the packaging. So one thing you need to consider is whether you include that as part of the cost. I would argue in a very simple example like this, you probably wouldn't. You're just looking at the costs of the French team and the value that they're adding onto the goods as they move through. You would also need to look at whether the pricing from Denmark is comparable enough to what France are doing. So this is where it starts, cost plus maybe isn't appropriate anymore. So we're constantly looking for, do you enter into arrangements with similar parties who do similar things, and can we use that pricing model to help with the transfer price rather than just a cost plus? So that's why you can see now why we really need to understand the business in quite a lot of detail to make sure that we've considered all the different possibilities of how you might price particular transactions. So sometimes what you might have in this sort of scenario is you might have another entity that's also doing that manufacturing third party and selling into France. So you could price that transaction in the same way as the Danish transaction. So,
Andrew, I'll ask a question in from Carl.
mhm.
We have a group that buys stock in the UK but sells it to the EU, sells in the EU, sorry. We're setting up an entity in the EU with OSS and we'll be selling to this entity before they sell to EU customers.
Yeah.
We proposed a 5% markup in the UK as it's just distributing goods. Is that fair? Question mark.
Yeah, and that's a good question. So let me just move on to the next example where I've tried to kind of capture that, Carl, with that France is now actually paying, it is actually now selling to customers. We see this much more exactly in your scenario where you've got a European entity selling into Europe and you've got the UK selling within the UK. Brexit's kind of increased this because it's a lot harder on some of the regulations for the UK to sell directly into Europe. 5% is probably okay. Remembering in this particular scenario, what we're looking at with France is what are they actually doing? So they're doing two activities. They're still doing that packaging on behalf of the UK, so that transaction still goes through. And then they're selling on behalf of the UK in the local market. So the way we would analyze this from a TP perspective is we'd separate out those costs. So we'd say the packaging costs, right? We can isolate all of those. We can put a markup on those. The selling costs, we can isolate those ones as well. We might have to allocate some overheads because there's some management that's doing both, and then work out what appropriate markup is. 5% is probably okay, depending on what you're putting it on top of, because what you might find is you actually might have one or two salespeople, the cost is very small. France might look at that and say, well, actually, the cost of doing the selling is 200K, but actually you're selling 10 million worth of goods. Actually, we'd prefer to have a percentage of revenue. So that's the potential argument that you might get into. What we would say in situations like this is, what is that French sales team allowed to do? And so what you want to try and do is you want to try and limit how much authority they have to conclude and sell contracts. Now, you don't want to stop them from doing their commercial activity, but what you do want to say is you have these parameters in which you can sell without getting authorization from the UK headquarter. But anything outside these parameters, you need to come back and sign off with whoever it is, the CFO, the COO, CTO, whatever it is, in order to manage that, and the price variations, things like that, because a cost plus implies there's no risk being taken by France, and you want to show that all that risk is being held by the UK, so they're going to get the excess profits on the back of that. Carl, have I kind of explained that kind of clearly? That limiting transfer pricing is always about what does the people actually do. If that French person is able to sign whatever contracts he likes, do whatever sales, then the French tax authority would argue that actually he has a lot of control over that, and so he should bear some of the risk and he should bear the excess profits based on that. But the more you can restrain his role to being just a salesperson, then you can start to look at whether a cost plus would be appropriate or not.
Right. That sounds like a good answer. We'll let Carl if he's oh yeah, he said thanks. There we go.
If you want to talk about it in the Q&A, Carl, we can also go through it. But kind of what I wanted to highlight here is you end up with profits here in this situation in the wrong place in France, and somehow you need to get it back to the UK. You might have it as a royalty for the use of for the goods. The royalty will incur withholding tax, so you need to think through that. There's a manufacturing cost that's sitting in the UK, so maybe you want to transfer that cost through to France. In other cases, we've done a strategic fee that the UK has pushed to France to try to pull that excess profit out of France to put them back in the same situation. But we would segment the French P&L to look at what was the appropriate margin, and whatever the residual that France is sitting on would come back into the UK. And sometimes that could be losses as well. So sometimes the UK might push a payment through to France while they're building up the business. Okay, let's talk quickly about IP. And the reason this becomes really important, look, intellectual property is the most critical part of this. In an early stage of company development, unless you're in online gambling or online gaming, the profits can't take quite a while to come. So you're sitting on a group with a lot of losses to begin with. You're trying to get financing to kind of cover those losses while you're in early stage development. This becomes really important about the transfer price and the profile of the group, because where do you want those profits to come when you actually move to that profitability phase? So what the classic mistake that I see is in this situation, so the UK, the headquarters, they do all the R&D, they've got all the senior people there. Again, we've got our Polish contract research and developer, but they want to sell into the US. So they think the US is a really big market. I know you're not all life sciences, but this is I see this over and over with life sciences company. The US is obviously where 90% of the profits are going to come from, the first market to launch, things like that. In this scenario, you need to be thinking 5 years ahead when you're profitable. Where do I want the profits, the core profits to come into? Because the classic mistake is that in the early stage, what we see is Poland sitting on losses, the US sitting on losses, and the UK sitting on losses. So those losses have been shared around the group. When the profits come, what the Polish tax authority says is, well, hang on a minute, we've been making losses for the last 4 years. You're now in the 5th year, there's profit in the group. We've shared in the risk of that development of the market and the IP and everything. So our profit should no longer be a cost plus. We should get a share of the total profits that come in. Same in the US, commercial, really important function. We've been sharing in the losses. And so this is why the risk process comes in. This is why we do the risk analysis about who can do what and how they can do it. Because ideally what you want to do is you want to capture all your residual profits in one location. It makes it a lot easier from a tax perspective to justify if you've got the substance to support it. So in this scenario, you want to make sure that Poland are on a cost plus and have been making a very small margin, but not sharing in the risk of the development of the product. The US, again, it's commercial in life sciences. There's strong arguments to say that the commercial is supporting the development of the IP. It's not the core IP. That's not always the case, depending on what the head of commercial is doing, as we talked about. But you might be able to get away with a higher markup. But what you want to try and do is isolate as much as possible all of the intellectual property, ownership, risk and return in the UK. That's not always the case. It could be another country. But the reality is in the UK, you're probably getting R&D benefits. You might be thinking about patent box in the future. It's a risk to your patent box if you've let your IP bleed into your US company or your Polish company. And we see this a lot, particularly in the early stage, because the loss-making companies think, well, we'll just leave the losses in Poland and the US, and then that's fine. And then the super profits start coming in Poland and the US say, well, hang on a minute, we deserve a portion of that. Yeah. and you move yourself into a profit split scenario where you have to then go through and say, well, Poland have borne this risk and the US have borne this risk, and start allocating profits between them, it becomes really messy really quickly. And if you are going for something like a patent box, it really starts to reduce the benefit that you might see on that long term. So spending a little bit of time up front thinking about, okay, how all this is going to work becomes quite important. And again, what is their role and what can they do, and trying to manage that piece as well. So again, what we would do is we'd come and say, well, who's really driving the value? And often in these scenarios, we might see it could be the science guy, or I've been doing work on a client where the CEO is just so fundamental to the business. Wherever he goes, unfortunately, he takes the profits with him. So he was in the UK to begin with, and then he moved to the US. So actually, we've got a movement of IP from one country to another. So it's very fact specific. But it's important to sort of sit back and look at it and go, well, actually, what are we doing now, but where do we want to be in 5 years' time, particularly what that profit profile is going to look like. I worked at GSK, and when I joined, they'd just come out of a really bad audit between the US and the UK, which resulted in a double tax of just over £1 billion to the US tax authority because they had not sat down and thought about what this looked like. And the US was saying, we shared in the risk of the development of those drugs, and so therefore we want a portion of the profits on it. So these capture the attention of the tax authorities, particularly when you don't have a structure in place at the beginning that you're then following the rules on. Now, it does create a problem, right, because you end up with huge losses in the UK, but the risk on that is you're going to get huge profits in the UK to offset them at a later date. But there's a balance to be made on this, to make sure that you're managing that. And I did just have a couple of other things just to consider on this particular example. So we talked about what if Poland does not recharge costs to the UK. So that is a big problem. The Polish tax authority is very aggressive in this place. They'll want a portion of the excess profits. Same as the head of commercial, how much control does he actually have, or how much does he actually have to go back to the UK in terms of what are the parameters that he can sell under? What if the US has some IP? Often you might buy another company in the US, so you need to consider how those pieces of IP integrate together, who has full control of them, how is that going to be managed? And then again, if you bleed things out into Poland and the US, you might have a patent box issue if you're looking to claim patent box in the future on the excess profits and get the lower tax rate in the UK. So there's a number of things to think about from an IP perspective, and it's worth having at least a conversation with someone to get a few ideas of how you might be able to structure this or set this up. And then also what parameters you might want to put on your head of commercial. So I was working with a US headquartered group who had bought some UK software, and they'd hired a head of commercial in Canada. And so we sort of talked through it, and we put parameters around that, what that head of commercial could actually agree to without having to come back to the chief technology officer and the CFO. And so therefore we could retain that control away from the Canadian entity in terms of a portion of the profits. You might do things like delegations of authority, those sorts of things to kind of help support that argument, but trying to retain one location of your IP. The minute you split IP, things become really complex and very expensive to get support to help with. Any questions on that? Because that is a big one. That's quite an important one. And I realise I'm kind of a little bit over time, so I'm going to have to scoot through the rest to get to the Q&A piece, which is the important bit.
Yeah, are we going to look at the 5 methods?
I wasn't going to go through the 5 methods, but I can talk them through with you.
I think I keep an eye on time. Like I said, I have to go in that 12 minutes. I think it'd be interesting to talk about the 5 methods.
Mm-hmm.
Right.
Let's go to the next one. So let's talk a little bit about TP documentation. I'll talk about it in the TP doc. So, and this comes up in the next thing. So being prepared for transfer pricing. So look, you just have to have legal agreements between all your entities, right? It's just a reality. I would highly encourage you to have legal agreements as the starting position. It's the basis of everything. Even if you don't have formal documentation, if you've got legal agreements that reflect what's actually happening that have been agreed, then that goes a long way towards ticking the box on whether you've got documentation. Even if you don't have legal agreements, have an email or something that you've sent between the finance teams explaining what the transactions look like and what the terms and conditions are. So we're going to apply a cost plus 5% because it's low value adding and we're quite comfortable with that, those sorts of things. So again, that comes down to the one that I've highlighted. Just have a bit of a policy around what your transfer pricing looks like and have it documented in something so you can refer to it. Most tax authorities aren't going to penalise you too much on documentation as long as you've got something written down to show why you've done what you've done. And it doesn't need to be a long, complex document. We're always going to ask for your organisational chart by legal entity. It's critical. Who are all your entities? And then look at all the transactions between them. And then we also want to see your management organisational chart with locations. So those are just the core things that you should be aware to have. People don't always have them easy to hand, but make sure you can pull them together. Other things to think about as your core documentation for transfer pricing, and any TP person is going to ask you for all of these things. Do you have a delegation of authority for spend levels or decision-making approvals? What's your 5-year plan look like? What's your profit profile going to look like within that? Do you have any sales commercial authorization frameworks that the group works under? Sometimes tax authorities want to see board minutes, particularly if you've got a board that meets in a location where a lot of the profit sits, but not a lot of other people. And is there any other documentation to support decision making? Formal documentation, TP documentation, is two things. Master file, which is really for really large groups, so usually 750 million revenue and over. But now local file, which the UK has just brought in and is looking at applying to a lot of smaller entities for each entity. So again, that's a detailed analysis of that functional analysis we talked about, the functions, the assets and the risks. The industry analysis, what's going on in the industry, how might that be impacting? That becomes important if the industry is doing badly. E&R and manufacturing have been doing really badly in the last few years. The industry analysis supports why the profits might have dropped over the years. Other industries doing really well, again, it'll support why there's excess profit in those years. The economic analysis. So as Elliot talked about, there's 5 methods that we look to apply in terms of determining what the price should be. So I've talked about a few of them, sort of, but not really. So the first one is a profit split. So a profit split is applied in that situation we saw before, where maybe losses have been incurred in the US and Poland. And so therefore we'd look at the total profit and then try to do an allocation to each of the entities who have borne in the risk. To say, okay, we've got a profit of 100 million, so we need to share that amongst the 3 entities. It's not just a third, a third, a third. Actually, we need to go through and make sure that everyone is being rewarded for their input into the development of that profit. So we see profit split a lot in life sciences, and we see it a lot in development of software. And we'll see a lot of it in AI, I would think, because lots of teams are contributing into that. The next method we've got is the resale price minus method. Now, I think this goes back to the previous question from Carl. Another way that you could price that transaction is you could say that in France, the sale price is $100 for each good. The cost to sell is 5. And so the transfer price might be 93, giving you a 2% profit on your sales. So the resale price minus is trying to work backwards from the sales price to take out all the costs and then to leave a small profit margin. So the transfer price would be 93 from the UK to France, leaving that 2% profit and covering their 5% of 5 of costs. So a resale price minus, we see a lot in those sort of sales entities in different countries, working backwards from what we know the final price will be. Companies like, so I was with GSK, that's how we did it to our local entities. We would do that resale price minus method back. Another method, we talked about cost plus a lot. Actually, we're talking about a slightly different method. When we talk about the cost plus method, what we're really talking about is where you've got a manufacturing activity that can be easily compared to other manufacturing facilities. The cost plus would be on the cost of sales. Oh, sorry, it's the cost of manufacture. So you look at your COGS and you'd say, actually, we can apply a markup on that because we can easily find comparables in the market. We don't use the cost plus method. This is awful, and I'm really sorry. We don't use the cost plus method on services transactions, because what we do is we base our we base the markup on what similar entities do. So a comparable search looks at different NACE or SIC codes to find companies who are doing similar activities. But when we look at a P&L of a manufacturing entity versus a services entity, the OPEX and the COGS are so different. You can't compare them. So the cost plus is looking at can be used for manufacturing or those sorts of things where the COGS are so similar, so we can test on a gross margin level. Whereas what we've got in the UK is another method called the transactional net margin method. The US call it something different because they're American, but we come down to the net margin and we compare it at that level of the P&L. Actually, it's probably the one thing that would make sense to most of you more than some of the economists that I work with. So we're trying to compare and look at comparables on the same basis. So we look at the operating margin, because actually all the OPEX, what people put in OPEX versus COGS and services entities can be quite different. So cost plus is more for manufacturing. The transactional net margin method is looking at the profit level, and that's what we would use as the cost plus determination. So we'd say, right, if services entities earn anywhere between 4 and 10%, I can choose anywhere in there, and that would be a cost plus on their total costs. Was that clear, Elliot?
Yeah, I think that makes a lot of sense. What I might do is bring on you the request that if we could work together after this, to maybe we'll do a little write-up.
Yeah, on the
Here's
different
your key
methods.
facts on
Yeah.
pricing methods.
The one that I've missed is what we call the CUP, the comparable uncontrolled price. We love the words comparable and uncontrolled and things like that. And that is back to the example. If you have the same transaction with a third party, that's the best possible price. So where you're getting one person to manufacture, say for Europe, or one person to manufacture for, say, the UK, can you use those prices to be comparable? And you might have internal ones or you might have external ones. And so we start with looking at, do you already have contracts internally that we can use? Often what we see is it's very hard to apply, because you might have one contract that's doing 100 million and you might have another contract that's doing 2 million. So we need to look at the comparability factors between them to determine whether they can be used or not.
Okay. So there's a question in from Zoe.
Yeah. Let's come back to this one. Let's do the last slide, and then I think that's a good example for the Q&A, if that's okay, Zoe.
Great.
So when do you need help? I've put a few things on here. I just want to pick out a few bits and pieces that I haven't mentioned. The key thing is who is doing what and where are they? So if you have key people who you think are quite strategic or decision-making or driving value in the business in a different location, you really need to think about whether you have a transfer pricing issue or not. Or if you were looking at it from that tax authority's perspective, what would you expect to see? The middle column, what I've tried to do is say what we do. I did a lot of M&A work for for KPMG, and what we're looking for is, where is the IP, the TP risk. Now, most of the time, TP is not a negotiating factor in M&A unless you've got some of these key indicators that you see here. So no policy has been applied, so the whole thing is a mess. They can, and I've been involved in negotiations where actually transfer pricing has become a big issue, because the entity buying it knows that they're going to have to sort out the problem and spend a lot of money on it. So one that I did recently, the IP was in one country, but there were no people to support that. That country is particularly aggressive, so we knew we were going to have to spend quite a lot of money in tax and pulling that IP out of that country and moving it somewhere else. So make sure you have something in place where you've actually thought through it. That's why I say just write up the policy. Even if it's not correct, at least you've got a thought process or a starting point. And then before you call the experts, look, we spend a lot of time interviewing people, finding information. So the more you have of that up front around what the value drivers of the company are, what those core documents are, what it is that you actually are looking for. Most of the time we start a project and they say, oh, we want the documentation, and then turns out they haven't actually got a strategy, so they need a strategy first, and then the costs start to ratchet up. And then the other thing I just want to highlight is, do you know the requirements in each jurisdiction? There are TP documentation requirements in every single country. They are all different. But EY, KPMG, PwC, and I'm sure Deloitte's do it. The EY one is one of the best ones. Free, online, big paper. Every country will tell you whether you're going to have a filing requirement for documentation or forms. So make sure you use those tools. They're really good, and I would highly recommend them. They're free. You just need to look up what the EY transfer pricing, and it'll come up with that as the first kind of thing. Denmark, you have to file transfer pricing documentation. Italy, you have to file documentation in a form, those sorts of things. So it'll give you a really quick overview of actually what you need to do, and then that'll help you define what it is that you need.
Yeah.
Right.
Sorry, Andrea. Yes, I'm going to interrupt you just there because I have to bounce.
Drop.
That actually was an amazingly helpful tip just at the end there. I'm going to promote you to host and then I'm going to log off. My hope is that that doesn't end the session. It shouldn't do. If it does, I'm really, really sorry, everybody. It shouldn't though, right? I think once you're host. I just want to say a huge thank you to everybody who's joined and Andrea, to you as well. We'll catch up afterwards on it.
There's my details if anyone needs them. If we do get cut off, please just drop me an email. I'm happy to answer and have a call.
So you should now be host. So I should be able to leave. Thank you so much. I think the thing that struck me as the most important that we were talking about, that might affect quite a number of us, is the need for detailed data.
Yes.
There's
Yeah.
a lot, and a lot of us are working with clients that are in quite a chaotic state.
Yes.
And actually just being able to establish what is the cost of this and what are we selling it for and how many sales do we even do in that country could be actually the first problem.
Yeah.
Not understanding that information. So I think that's really driven that home. So thank you, everybody. I will catch you on the next one. Please reach out if you're interested in learning more about the Fractional Finance Forum. And if you would like to sign up to our next round of events, we've got some really exciting things coming up this year. And Andrea, thank you so much. I will leave you as host. Thank you.
No problem. So hopefully you can stay on for a minute. I can allow you to talk as well. So just on your question, India, look, India is a really difficult. I'm going to just get rid of the slides for a sec, so I can maybe see. India is a really difficult country. Because everything is very low cost in India. There's lots of people who've set up in India. They really like high margins. I know that sounds a bit difficult, but 5% may not be enough. They prefer to see anywhere between 10 and 20. So what it sounds like you've got a service that's being provided from India, a financial support, probably back office up into the UK.
Sorry, Andrea, it was actually just an example because I was really interested to hear the difference between the service-based one. I wasn't aware of that. So the India example is an interesting one to hear their policies as well, but it's more of a outsourcing to any country from that service base. Like how would that usually look?
That's right. So you take so any country will operate in exactly the same way, as they will take what is the fully loaded cost of providing that team? Is it going to be an entity? Is it going to be a permanent establishment or a branch or something? All of the cost, and then add a markup. Now, most countries will accept if it's just back office finance, that it's probably 5% low value adding. You'll probably get away with that, with the exception of India. They're probably the one country that they're the exception to every rule, where you might just need to look at actually maybe slightly higher markup. They're very aggressive. If the transaction's small, you might be able to get away with it, but most countries are in litigation in India and it costs a fortune. So it's worth just thinking about with India if that's helpful.
That's really helpful. Thank you. Really interesting to understand. So essentially, it's the same approach, but the markup would potentially need to be higher depending on the jurisdiction.
Exactly. Yeah, and the UK are a bit frustrated, and they're taking a number of cases to with India about the heavy markups that they're expecting. I can't see it changing personally, but it's nice to see that they're taking up the taxpayers' mantle and having a bit of an argument with them on it. So it'll be interesting just to follow that. But India is one of those countries you need to be a bit more careful with. And then Dania, Leviathan stock, that was for the UK, but can it be used here? Yeah. So, okay, so my first question would be, why is the foreign entity loss making? Maybe that's existing services that are in there. I might be able to promote you again to talk. So you'd want to make sure that the losses in the foreign entity are not related to anything to do with this particular transaction. Because if you think that foreign entity can actually sell it, then maybe what you want to do is put some sort of a percentage of the revenue into that transaction. So the UK, and again, this is why documentation becomes critical, because the way I'd write this up is the UK have tried to sell the goods, they can't, they've incurred loads of costs for it. They can either write the costs off and have a bigger loss, or they can try and sell it through another country and try to recoup some of them. That's okay. If you can document that clearly from the UK perspective, because it's kind of in a stuck situation, the risk is really on the foreign entity. The foreign entity shouldn't make a loss to support the UK entity. The foreign entities tax authority would say, well, hang on a minute, they didn't have to do anything on this. So unless they've done it, I have seen situations where the foreign entity's just done it and the UK's gone, well, okay, but it's a loss for us. In that case, it's slightly different. The fact scenario's changed. But if the foreign entity said, actually, we could help you out with that, then they would expect to have a profit in the foreign entity, and the UK would be expected to bear the residual of the losses on that particular transaction, bearing in mind that the opportunity cost was actually a complete loss of the write-off of the stock. Again, I'd have an email or a memo or just write up a one-pager or something on that just to show why that business or commercial decision was made in that way to support that. I don't know if does that answer the question?
Yeah, can you hear me?
Yes.
Yeah, no, it does. I think, in fact, it helps a lot because from my perspective, the losses can stay in the UK because the UK entity is profit making. Foreign entity is loss making because it's a lot smaller and it's new and it's not built itself up yet. So really, it was just about what can we transfer over there so that the losses as much as possible stay in the UK, but reflecting that it's going to be beneficial to that entity.
Yeah. I would take a look at your foreign entity and say, well, hang on a minute, should it be loss making, and even in the early stages? Because if the expectation is that it's just going to be a low risk distributor as such, then maybe the UK should bear those setup costs in the initial years, so that when it does get to profit making, you can leave it with a very small margin, usually 3 to 5% or 2 to 5%, depending on what the industry is. If it bears a lot of losses in those earlier years, the tax authority will say, well, they're no longer low risk, they're just a distributor, and so we would expect to see a margin of 5 to 8%. So it's worth just categorizing what that foreign entity is and whether the UK should help with those losses in the early years. It doesn't need to bring it up to profit, it could even just bring it up to break even.
Okay, I think it's quite a unique situation because actually the two entities operate very separately.
Okay.
And make their own manufacturing in their own.
Okay, that makes sense.
It's just the fact that there's this one stock issue, quite large amount of stock that all of a sudden had to be redirected and rediverted. So I don't think it's an ongoing expectation.
That makes sense. I think that was all the questions, but Charlie, Kirsten, Pete, I noticed you've stayed on. Did you have any specific questions that you wanted to ask? I think I can make you all allowed to talk. No, maybe they've already dropped off. But if you do have any other questions or you do have any other scenarios you just want to run through, I'm happy to have a quick conversation. My email